DSCR loans. Man, these are some of my favorite loans to do. And honestly, that's because of you guys. So you guys that are tuning into the channel, that are bringing us loan scenarios to review, you guys are the ones that are actually moving the needle and helping us explore more and more different wholesale lenders from which to add to our collection of lenders to offer better DSCR products and better DSCR terms. And these types of loans are by far, hands down, some of the more popular investment products across the country. Now, of all the financing conversations that we have day in and day out, DSCR loans are by far the most common conversation topic that we have. And today, we're gonna dive into the DSCR Cash-Out Refinance. This is a move that lets your rental property become a piggy bank. You could dive into your own private ATM without ever having to show a W-2 or tax returns. Now, if you want one of our numbers on your own DSCR project, my Calendly link is located below, so go ahead and book a call for that. But first, my name is Jeremy. I am a certified mortgage advisor based in Phoenix, Arizona. We lend all across the country to homeowners and home buyers. We empower realtors and we advise and consult with investors to help create leverage using financing strategies for both their generation and generations to come. Thanks for tuning into the video. Hope you enjoy this one. But first off, DSCR. Now let's recap what a DSCR loan actually is. DSCR stands for Debt Service Coverage Ratio. Simply put, if the property that you're looking to finance is able to generate more income than what your total debt would be on that property every month, including principal, interest, taxes, insurance, and HOA dues if applicable, then you're golden. Now, if it more than covers the payment, even better. The magic with the DSCR loan is we do not look at personal income, gangs. Okay? We don't look at tax returns. We don't look at bank statements for income. We also don't look at 1099s or W-2s or verifying employment, any of those sorts of things. If you own an investment property and there's equity in it, chances are you can refinance it and pull some cash out, even if you don't have a traditional job. This is exactly why the DSCR loan product has blown up in popularity over the past 5 to 7 years. They let investors stay in investment mode, and there's a lot of great strategies behind how to apply a cash out refinance in your portfolio. All right, so let's talk about the top 4 reasons, roughly. There's probably more, but let's talk about 4 reasons why a cash out refinance would be a good fit for you as an investor if you have a property with equity. Number 1, let's talk about recouping your rehab funds. So some of you have heard of the BRRRR strategy. BRRRR stands for buy, remodel, refinance, rent it out, repeat. This is the classic playbook. Investors have been doing this strategy for years. So let's talk about the timeline there. So for a BRRRR, the objective for you is going to be get into this property. You're either paying cash on a property that needs to be fixed and flipped, or you're going to use financing for that, which is a whole other video. So you get into the property, you rehab the property. Let's say that takes 3 to 4 weeks. Then you're going to start the refinance process. You could even start the refinance process when you close on it. We could talk about that more in our strategy calls, but we have lenders that offer no seasoning. So what that means for you is if you close on a property today, and let's say today is December 31st, the very next day, well, that's a bad example because the holiday would be January 1st, but the very next business day after December 31st, you could start your refinance process. You need no seasoning. You just need to show the settlement statement from purchase and that you are actually on title. Now, those same lenders that offer no seasoning will also allow us to use the new appraised value by getting an appraisal completed to use that higher after repair value from which to borrow a percentage of for your refinance. Some lenders may not allow that. They may want you to use your purchase price when you first bought it with cash or with a fix and flip loan. That really limits your ability to pull cash out. It might even be difficult to pull out everything you put into the property. So those no seasoning lenders, they are rock stars when it comes to these quick fix and flip turns to get in, get your money in, get your rehab done, pull all that money back out, and then move on to the next project. And I've had a lot of investors ask me lately, Jeremy, are people really using a fix and flip loan or paying cash to buy these properties, remodel them, and pull all of their money out? The answer is yes. And the other sub answer is, and then some. So investors are still doing this today. It is not difficult to do if you're in the right market and you're buying at the right discount. And we can run those numbers for you. So just reach out to me if you want some more details on that. And the second reason people will use a cash out refinance using a DSCR underwriting would be to pay off a hard money loan. So hard money is like espresso, right? It is strong, it's effective, and it's way too expensive on your health to sip that thing long term. You use it to acquire a deal, get your remodeling done, and then you can use a cash-out DSCR refinance to get rid of the hard money lender and get your long-term financing in place. Now, this move alone is going to save you thousands per year by flipping your hard money over into long-term DSCR financing. Third reason people use cash-out DSCR refinances is to improve the property that you already own. So you've already had a rental for a period of years, 2, 3, 4, 5 years, and that property, it was in great shape when you picked it up. Maybe you rehabbed it when you first picked it up in 2020, 2021, but now things are starting to fall apart. You might need a new roof, you might need to add on an AC, maybe you want to convert a space into a livable area. Well, cash-out DSCR refinances are a great way to do that. When you pull that money in, you can use that money for whatever business purpose that you want to use those funds for. That can include improving the property that you already own. That could also improve taking those funds, placing them onto another property that you already own to improve those properties as well. It's a great way to get capital out of your homes. It is a loan, so it is not a taxable event as well. So all those dollars are yours to keep within your business and apply toward other properties. It's a fantastic strategy. And fourth, probably goes without saying, but if you pulled out a good chunk of money out of one of your rentals, you can use those funds for further acquisitions. You can use that cash out that you're getting to apply to another home purchase, maybe another fix and flip loan or a bridge loan on another deal that you're buying, to repeat the same process over and over again that you've just done with your BRRRR strategy. So all these options are fantastic ways to leverage the funds that you're pulling out of your property to increase the value of your portfolio, to increase the rents that you're getting by having a nicer, more attractive property on the market for your rentals, and to go buy more. All right, let's talk about DSCR guidelines. All right, let's talk about the loan requirements here. So first off, loan amounts. We can go up to $2.5 million. A lot of times we can go up to $3 million, and this would be for a 1 unit or 2 to 4 units, and DSCR ratios still matter here. So just keep that in mind. As your loan amount goes up, we still have to show enough rents coming in to support that payment. The property must cash flow. So that's an important piece here. So the higher the loan amount goes, the more strict the lender's going to be about that property actually cash flowing. When you're in lower loan amounts, what I've found is there's a lot more lenders out in the marketplace that are available for you that will refinance even if you do not cash flow. Let's say you're slightly negative on your cash flow, they'll still do the loan for you. The percentage you can borrow might go down and the rate will most certainly go up a little bit, but you can do it. Additionally, we have no ratio options for some of these loans, which is if their cash flow is not great at all on long-term rents or even short-term rents, yet your use for that property may not fall into one of those buckets. So you have a use, let's say, that is going to double or maybe even triple what that payment's going to be. Some of these examples include mid-term rentals, medium-term rentals. So we have one client that rents out his units to folks that are in the airline industry, so pilots, flight attendants, etc. Those would be good options because the no ratio DSCR loan, while higher in rate, will still be a potential home for your loan. You can only do this on investment properties, so primary homes and secondary homes, no need to apply. No personal income or job needed, so we don't need to show employment or prove employment. We don't need W-2s, tax returns, or bank statements reflecting income. And there's an unlimited financed property cap. So we have some of our clients that are up to 80, 90, even over 100 units in their portfolio. Some of them have many, many mortgage trade lines on their credit reports. We can still do DSCR loans, okay? They do not care about the Fannie Mae guidelines for how many finance properties you can have on your credit. No problem there. As far as terms go, 30-year fixed terms are most common. Now, if there's an opportunity for you to get into a positive cash flow situation by flipping the 30-year amortized term into a 30-year interest only, the interest only is a little bit lower on the payment. Now, you're not going to pay down any principal with that payment, so keep that in mind. You're not going to move the needle at all in what you owe throughout the duration of the loan. But if it's a factor of getting into the property and getting a positive cash flow to decrease your rate so that your cash flow monthly is stable and it meets and aligns with your goals, that could be an option. Same thing with 40 years. So we do have 40-year amortized loans. We also have 40-year interest-only loans. I only use those in rare situations, and generally I don't recommend them. But if it fits for your model and what you're trying to do, whether long-term or short-term, those can be a game changer as well. Just keep in mind too, you're going to need to make that payment, so you can always pay more than your payment every month, but you can never pay less. So if you have a tremendous amount of cash flow going in, every month into your account and you want to apply that extra cash flow toward your principal, you can definitely do that. Just make sure to check the terms of your prepayment penalties to make sure that you're not going to trigger any of those expensive prepays by paying extra principal. Next up, we'll talk about reserves and some of those requirements. So reserves, just as a recap, 1 month reserves is simply 1 month of your all-in debt service coverage ratio payment, okay? That also includes HOA where applicable, so principal, interest, taxes, insurance, and sometimes HOA. That's 1 month reserves. A lot of lenders will require 3 months, some require 6 months, and depending on the other variables with this property, it could mean that you need more than 6 months of reserves. Generally, more complex files will require 9 months or 12 months, but for most of us here, we're looking at 3 months to 6 months. And hot tip here, you can use your cash out towards your reserves in a lot of cases. And really, lenders just want to make sure that you're not 1 or 2 months of vacancy away from a disaster. All right, let's talk LTV and credit requirements. So for LTVs, what I recommend is if you can settle in that 75% LTV range, you're going to be in good shape. There are lenders that offer 80% cash out, but what I'll tell you, and what a lot of investors find out is, once you go from 75% to 80%, the rate does go up. So don't be surprised if the rate increases by a half a point, 3/4 of a point, maybe a full point higher by going from 75 to 80. Higher risk. It is a little bit more of an overlay by these lenders to mitigate some of that risk on their end. So that's why they charge more. So if you can sit at that 75% threshold or even less, you're going to experience the best interest rates out there for DSCR cash out refinances. Minimum credit score, I'm going to target 640 here. There are lenders that do a little bit lower of a credit score, but the rate gets so high that the ratio ends up generally not working. So if you're at 640 or even that 660 range, anywhere in there and up, you're going to be in good shape for a cash out refinance. If your credit is in the mid 600s, that also may mean that instead of 75% as your target LTV for cash out, you may be at that 70% mark or perhaps even 65% just because of that credit requirement. So strong pricing, 680 and up. With some lenders, when you get to that 7 to 720 range, your pricing is premium. It doesn't get any better between 721 and 849, for example. Now, seasoning, I mentioned earlier, some of our lenders have 0 seasoning or even 1 month seasoning for holding that property, investing in your LLC or in your personal name, whichever you prefer. Some lenders have a 3-month or a 6-month window with which you have to have seasoning on title before you can do a cash out. I would look at both options. If you have some time, the more time that you spend vesting that LLC or your name in these properties, the more lender opportunities there will be for DSCR cash out refinances, which means you'll have a lot more opportunity, a lot more options to work with, which could potentially mean lower rates. But that said, we do have a couple solid options with 0-month seasoning, and these are very, very attractive options for our fix and flippers that are looking for quick turns. A few other investor-friendly features with some of the DSCR cash out options is condominiums, and condos can be a little bit more difficult in a lot of ways. HOA documentation and communication with the HOAs can sometimes be more difficult, so it does take a little bit more time in the process of the refinance. But non-warrantable condos, and these are condos that for some reason or another, they don't fall into the HUD's definition of what warrantable actually means. And some of those reasons could include there is a substantial percentage of units in the condo complex that are owned by investors, or 1 or 2 or 3 investors own multiple different units in a condo community. That will cause some of these associations to fall out of warrantable compliance. Pending litigation would be another one. Reserve requirements, the HOAs have to have a certain dollar amount of reserves on hand, and if that falls below a threshold, that could also pull them out of warrantable situations there. So with condos, make sure you have a good feel for, is this a warrantable condo or non-warrantable? And if you're not sure, we can help you find that information out too. Now, another cool guideline here that I found with a lot of lenders is if you have actual leases in place, and those leases that you have in place for your units are higher than what the market rent on the appraisal will show, we can use the higher of the two. If your actual lease is lower, but yet market rent is higher, we could potentially use the market rent on the appraisal rather than your actual rental rate. So keep that in mind. That's a huge one. Now, short-term rental properties, we see a lot of short-term rentals scenarios come across our desk, and a lot of those are very, very strong income producing properties. There are DSCR options for short-term rentals. Going back to some of the specific guidelines that we have, it may limit the amount of lenders in the pool available to get a short-term rental cash-out refinance done, but we do have them, they do exist. So the critical component there with a short-term rental is talk to a couple of different lenders. Brokers are a great choice, like us, because we have options at 180 plus different lenders from which to choose. A lot of those have short-term rental underwriting options for DSCR cash outs, and they could be a good fit for you. All right, really in closing, if a DSCR cash out is something on the horizon for you in the next 3 months or 6 months, we'd like to chat about it. Whether it's to scale, whether it's to fix and flip, or finally exit that hard money loan that they're working so hard to get rid of at 10, 11, or 12, or even 15%. I know it feels like loan sharking when you get interest rates that high, but there's a reason the money costs what it is, and a lot of fix and flippers deal with the same sort of loan products. My Calendly link is located below. Would love to chat with you about your scenario, so go ahead and book a call, and we're excited to talk about your scenarios and help however we can. We want you guys to win. Thanks so much for tuning in. Really appreciate you guys being here. If you have any questions or comments on DSCR cash outs, please drop them in the comments below. And I hope to hear from you on my next Calendly call. And don't forget to like and comment below. We would love that. And subscribe to the video. Our goal is to continue pushing out content appropriate for financing strategies, both for investors, to help empower realtors and their clients, learn about how financing works, and to consult with our homeowners and home buyers as well to make sure they're getting the right loan product for them. So thanks so much for tuning in. We'll see you in the next one.